What are mutual funds? What are index funds and how do they differ from ETFs? Do actively managed funds even beat the market? In this video, we'll go over all of those topics and add more important details to the story. But before we do, feel free to subscribe and ring the notification bell for more personal finance, investing, business and motivation related content and weekly book summaries. Since mutual funds were first of the bunch to appear, let's start off with them. Mutual funds are designed to allow multiple investors to pool their money together and invest in securities like stocks, bonds, and other assets. These funds are actively managed, meaning that they're operated by professional managers who pick the fund's assets to try to produce good returns for the fund's investors, meaning that the fund's performance depends on the manager's skills. So, mutual funds are a convenient way for investors to buy a bunch of different stocks without having to buy each and every one separately. You just buy the fund, and that's pretty much like a basket that holds all the underlying stocks. Yep, with just one purchase, you end up buying multiple stocks, hundreds or thousands even. Imagine how much time it would take you to buy hundreds of stocks if you went through and bought all of them separately in hopes of lowering the risk by diversifying your portfolio. And now add to that the fact that you would have to pay brokerage fees hundreds of times also. With a mutual fund, you just buy one fund and pay the transaction fee only once and your portfolio is diversified, at least if the underlying holdings are. Now, those hundreds of stocks still need to be picked one by the fund's managers, and since they do that for a living, they charge fees for the benefit of you having the access to their time and expertise. This compensation is referred to as management fees. A very important thing to note here is the fact that most of the time the fees remain the same regardless of the fund's performance. Yep, that means that your fund manager can end up losing you money year after year after year after year and still get paid millions for his amazing services. Okay, but how much do they even charge? Well, management fees usually range between 0.5 and 1% of total assets under management. So X% of your whole portfolio, which doesn't sound like a lot, but adds up to significant amounts over the years. Let's take a look at this example. So this portfolio started with $10,000 as principal, and we kept adding $1,000 every month, and you can see how that compounds at 8% interest over 30 years. The green area represents the interest alone, and it's a major part of our portfolio. Now I'll keep the blue area, which is the total portfolio value, and this yellow area is what the portfolio looks like if we have to pay 2% fees at the end of each year. Now that's a significant difference. And look, it gets even worse if we extend the time horizon. But why did I use 2% here when management fees are usually up to 1%? Cause what about the operating fees? The what? The operating fees. Funds need to pay for trading costs, marketing, legal costs, office supplies, customer service, and so on. All of those are operating costs. Now, many people confuse management fees with expense ratio. Expense ratio includes both management fees and operating costs combined. This means that expense ratio is the total percentage of your portfolio that will be used to cover all expenses combined, and usually that ranges between 0.5 and 2%. Another thing to bear in mind is the turnover ratio, which is the percentage of a fund's holdings that have been replaced in a given year. More turnover tends to generate more trading fees and taxes, thus increasing the operating costs. All these fees and costs annoy a lot of people, and they especially annoy Jack Bogle, the founder of Vanguard Group. So to get rid of most fees, he designed a completely new kind of funds that are passively managed instead of having a human pick the stocks. Those funds are known as index funds. So how do the stocks get picked then? Well, they get picked by a computer, and instead of it having to decide which stocks to buy, it simply buys something known as market index. A market index represents a segment of the market, and that's basically a bunch of companies separated by industry, by size, by region, by past performance, or something similar. So the underlying index sets the rules by which stocks are included, and then just tracks the stocks. An index lets you see the performance of a whole segment of the market just by looking at one index instead of hundreds of or even more individual stocks. Index fund is a type of mutual fund that simply buys whatever stocks are in the index. So yes, all index funds are actually mutual funds, but they are passively managed subcategory of them. Some of the more popular indexes you'll hear mentioned around often are the S&P 500 that tracks 500 large US companies, Nasdaq 100, which consists of the largest non-financial companies listed on the Nasdaq, and the Dow Jones Industrial Average, the Dow, that tracks 30 blue-chip companies trading on the New York Stock Exchange. So, an index fund that tracks, for example, the Nasdaq 100 just keeps buying the 100 stocks that index tracks and smashing the like button for the algorithm. Simple and easy. When it comes to management costs, there aren't any, as the computer doesn't demand a salary, but it does demand some operating costs. Now, removing active management also tends to lower many other operating expenses, which is why expense ratios of index funds range between 0.015 and 0.6%, depending on what they're tracking. ETFs, or exchange-traded funds, are pretty similar to index funds. The main difference is that they trade like a stock, so you can buy and sell them much more easily than an index fund, even many times a day, unlike index funds, which are often limited to only one transaction a day. While index funds allow you to set up recurring automatic payments, ETFs don't have automatic payments, but ETFs have lower minimums, usually down to $1, compared to index funds that sometimes require thousands of dollars as a minimum deposit. Now, since there are many different kinds of indexes, there are naturally also many different kinds of ETFs. And to make things more complicated, there are sometimes multiple ETFs that track the same index. So let's see some ETF choices for people who look to invest into popular indexes that we already mentioned. As you can see, the S&P in this example has two different ETFs tracking it, and they have different expense ratios. Since they both track the same index, the expense ratio is the main and most often the only difference between them. That's why it's important to check it before choosing an ETF to invest in. Popular index tracking ETFs are what comes to most people's minds when somebody mentions the term ETF, but as we already mentioned, there are many different kinds of them. For example, sector ETFs, growth ETFs, value ETFs, regional ETFs, bond ETFs, commodity ETFs, currency ETFs, dividend growth ETFs, real estate ETFs, and so on. There are even websites such as etfdb.com that are designed to help you do some digging and research and find the kind of ETF you want or need. Very important things to always check before buying are what the ETF you're looking to buy actually invests in and whether it's leveraged. Yes, some ETFs use leverage. These most often buy options and/or futures to amplify the gains and losses, and are designed to be used for short-term trading rather than long-term investing. While a quote-unquote normal ETF tracks the underlying index 1-to-1, a leveraged ETF targets, for example, a 1-to-2 or 1-to-3 ratio, meaning that the gains and losses are doubled or tripled respectively. And since all of the financial instruments used to amplify these gains carry fees, the operating costs are significantly higher than those of quote-unquote normal ETFs, so the expense ratios tend to be around 1%. Using leverage seems innocent enough, especially in the short term, but there are some risks here hiding in plain sight. Let's take a look at this situation for example. Your ETF is priced at $100 when you buy it. The next day it goes up 10%, and the day after it drops back 10%. Without leverage, your prices would be 100, 110 and 99 respectively. With leverage, your prices are 100, 130 and 91 respectively. You can see that volatility turns out to be way more costly, and price movements that are almost negated by default can generate significant losses when using leverage. Another even more obvious fact is that if you're using 3 times leverage, a drop over 33.3% will wipe out literally your entire portfolio, and those are not impossible. In fact, even this year, the market went down over 33.3% in just 33 days. Cool coincidence. On top of leveraged ETFs, there are also ETFs that invest only in derivatives in hopes of tracking the price of whatever they're trying to track. This may cause rollover issues, and it's not guaranteed that such ETF will actually succeed in accurately tracking whatever it's trying to track, especially in the short term. So again, do some research before you dive headfirst into an ETF. If, for example, you're looking to invest into gold and want to do it using an ETF, the fact whether your ETF holds physical gold, buys gold futures, invests in gold mining companies, or invests into golden like buttons makes a huge difference. Okay, we still have a huge elephant in the room left to address. Most people use index funds as a passive form of investing to track a market index and in turn capture market returns over the long term. Nothing more and nothing less, they just set it and forget it. But actively managed funds have high-paid managers with degrees, big brains, fancy computer-aided research tools, and robust data working for them and picking the stocks to try and make you more money than just a simple index. The task sounds simple enough, as in every index there are going to be stocks that outperform it and stocks that underperform it. The index is their collective average. So the managers just have to figure out which is which and only buy the ones that are going to outperform, thus making better returns. But can they actually do it? Well, yes and no. Depends on the fund and the time horizon. While you might find some funds that will outperform the market in the short term, the longer the time horizon gets, the lower the chances are that a fund will keep outperforming the market. Depending on who you ask, only between 7% and 20% of funds beat the market over a 15-year period, while that number drops to under 1% over a 30-year period. The fact that a fund is doing great at the moment does not mean it will keep doing so. When you add up additional fees on top of that, the situation becomes even more in favor of the passively managed funds. Now, index investing is a very popular strategy and there are many great books and other resources that you can use to learn more if you're interested. My favorites are the Little Book of Common Sense Investing, The Simple Path to Wealth, and The Boglehead's Guide to Investing. I've already summarized 2 of these and the final one will also get summarized soon, so stay tuned. There is also r/Bogleheads community on Reddit that has thousands of cool index investing fans subscribed and many financial independence threads are also full of Bogleheads. And finally, thank you for watching, and I really hope this video was useful to you. As a final note, let me just clarify that none of this is investment advice. You should always do your own due diligence before investing, as it's your money and you and only you are responsible for the consequences of your own actions. With that out of the way, really thank you all for sharing the videos with friends and of course destroying the like button. Thanks to you, the channel is at over 200 subs already. And there is much more investing, personal finance, business and motivation related content on the way, as well as weekly book summaries, and I really hope it's gonna be useful to you. I'll see you next week, so enjoy the rest of your day. Bye bye!